Hello there, welcome to another video on investing on the stock market and welcome to a brand new series. Now I got this idea from another YouTuber called Jeremy over at the Financial Education channel. Very good YouTube channel. He's done some of these, so I thought I would do some. Now I'm going to compare four sort of similar companies and sort of try and decide which company is best. Now these four companies, important to notice, are quite different. They're all major diversified US tech companies, but they do different things. So they're not direct competitors, but in terms of investing, I think a lot of people would put these stocks in the same basket. And you wouldn't necessarily buy all of them, you would maybe pick one or two. So I'll go through some numbers. And this is brand new, so it's important for you to give me some feedback on what you think, if you think this is a relevant comparison, and if you like the numbers I've picked out, okay? So we're going to start off with 5-year revenue growth, which is how many percentages a company has grown its revenue over the last 5 years. Net margin, which is how much money a company is left with after all expenses on their products and services. Cash, which is how much cash they have on hand and equivalents. Free cash flow, which is the money a company is left with after it has paid all the expenses it needs to maintain the current state of the company. Okay. EPS is earnings per share, which is how much revenue a company can generate per outstanding share of a company. So this is how profitable a company is. And then you have price to earnings, which tells you how expensive the stock is, where you compare the stock price to the earnings of a company. So for all of these numbers are not going to be equally important for all of these companies. So even though Google has grown 120% and Microsoft has only grown 13%, doesn't mean Google is way better than Microsoft, okay? There's a lot of different factors you have to consider, but these are some numbers I've chosen out. Now I'm taking some time to explain this for the first video so that you can give me some feedback on this format. So Google has grown its revenue by 120%, which makes out to 24% annually over the last 5 years. Very, very strong growth, especially for such a large company. It's what, 700-800 billion market cap company. The net margin is 11.4%, quite low for a tech company, but Google does a lot of different things, right? They have $102 billion in cash, which Google is using to buy up smaller companies. Google tend to buy small to medium tech companies with important pieces of technology that they want to use for all their platforms and services. They have $24 billion in cash flow, which is massive, even for such a large company. So they're very cash positive. It's a cash cow, really is. They have an earnings per share growth of 18, which is insane. Very, very good. So it's a very profitable company. And it's somewhere in the middle at 64 PE, which is quite expensive, but you have to remember that this is a tech company, it's not a hardware company like Apple, so the valuations are going to be quite high, but as you can see, the growth is probably worth it. Microsoft grown at only 13% over the last 5 years, which is quite bad, even for such a large company, growing at 2.6% a year, which is almost like the S&P 500 average. They have very high margin, which you wouldn't imagine for Microsoft, 23.6%, very strong there. They have $130 billion in cash, which I believe is the second biggest in the world, only second to what company? So they have more money than they could ever imagine spending, at least in the short term. They only have $8 billion in free cash flow, which is a little bit disappointing for Microsoft, but they might have a lot of expenses they have to pay. They have 2.7% earnings per share, which is very, very low, not good. And then they have a very high PE of 79 PE. It's gone up quite a lot lately. People are a little bit more optimistic about Microsoft and it also pays a very good dividend, and they have a great CEO now, and they're doing quite well in the cloud space, and they still have Windows and Office and everything, so quite a strong company at the moment. Moving on to Facebook, done about 80% in revenue growth, less than Google, which is very, very surprising since Facebook is a very young company. So that's about 16% revenue growth every year for the last 5 years, almost 40% margin. This is the crazy thing about Facebook. It has some of the highest margins, both gross margin, operating margin, and net margin I've ever seen. So it's a cash cow, a very, very profitable company. $42 billion in cash, which is decent considering Facebook is only, 13 years old or something like that. They have $17 billion in free cash flow, which is very good for a company Facebook size. Facebook is nowhere near the other three companies, so this is a very strong free cash flow. It's Facebook has such low expenses, it's crazy. They have 5.4 EPS, which is not too great for Facebook, but it might get better. And they have a 34 PE ratio, which is, in my opinion, is quite affordable and quite cheap for such a good company. And we have to see where Mark Zuckerberg can take this company. Then we have the king of stocks, which is the one and only Apple. Done about 50% revenue growth for the 5 last years, which is quite insane considering it's the world's largest company. That's 10% every year, way above the S&P 500 average. They have a 21% net margin, which is very high for a hardware company. This is the only hardware company, so Apple should have way lower net margin than these companies, but because of the strong brand, they actually have a quite high one, almost double that of Google. They have the world's largest cash hoard at $270 billion in cash and cash equivalents. Now, a lot of this is overseas, and it's not like Apple has $270 to just spend tomorrow. So take this with a grain of salt. And Apple is not a company that does a lot of acquisitions, and we don't really know what they're going to spend that $270 billion on. If I had $270 billion, I wouldn't know what to do with it. They have $50 billion in free cash flow, which is the world's largest free cash flow. This company is the biggest cash cow in the world. It seems like they have to put in very little effort to make money. Ridiculous company. They have a 9.2 earnings per share, which is quite good, way above Microsoft and Facebook. And then they have only a 18.5 price to earnings ratio, which is incredibly cheap and reasonable. But it is a hardware company mainly. It's not a tech company. So that's why the PE is a bit lower. But Apple is making a lot of its money from services. So, it might end up being a tech sort of company in the end. Now, keep in mind, I'm personally invested in Apple. So keep that in mind through the whole video. Now, as a sort of a conclusion, all of these companies are great. You have the young gun, which is sort of the king of social media. Facebook has 2 great platforms, Facebook and Instagram, doing very well. A visionary CEO, amazing company. I'm a little bit afraid that Facebook is not going to grow a lot anymore. But I do think Mark Zuckerberg can get some other revenue sources going for Facebook. Microsoft has been like a sort of a slow-moving giant for a while, but they have a new CEO, they have a new plan, they're working really, really hard, and they have one of the world's largest network. And Microsoft probably has the biggest network in technology because they have so many business customers and so many services that people depend on all over the world, both personally and professionally. There's a lot of systems which runs on Windows, so very important company. Also pays a good dividend. Google is as diversified as possible. They make a lot of money from ads, obviously, but they have services and hardware and all sorts of stuff they sell. So this is sort of almost like an index fund of tech. Very safe company, very big, still growing really fast as you can see. Very profitable. They have some of the most important platforms in the world. They have Google.com, YouTube, and Google AdSense and Google AdWords, and it's just an amazing company, obviously. My personal holding, Apple, I think is an undervalued stock. I think they have a very good CEO. He's not as much talked about as Jeff Bezos and Elon Musk, but he is great. It's one of the most profitable companies in the world. They have the strongest brand, and if we look at the numbers, Google clearly wins out on the revenue side. Then we have a big winner in Facebook in net margins. Apple obviously has the most cash. They obviously have the most free cash flow, but keep in mind Apple is also way bigger than these other companies. Well, not way bigger, but quite a bit bigger. I think they're almost twice the size of Facebook. Google, clear winner on earnings per share, so probably one of the most profitable companies, and Apple has by far the lowest PE, which I don't think is deserved, but that's up to you to decide. So have a look. Now, I would personally invest in Apple. I'm already invested in it. After that, I would probably go with Microsoft, then Google, then Facebook. I'm just worried about Facebook because they're so reliant on actually www.facebook.com, and I'm not sure if it's going to be the big thing in the future. And I don't think it's going to take a lot to derail a Facebook right now. But they're sitting on a lot of cash. They have a great CEO. They have Facebook, Instagram, and WhatsApp, and Oculus Rift. So they have a lot of avenues they can go. So let's see what they do. Let me know what you think about this concept. Next, maybe I'll do what? You decide. Maybe banks, semiconductors, e-commerce, retail, apparel, you decide. And until next video.